today we have incredible lender, one of the absolute best lenders because he's my lender from day one that I've been in business since 2006. And we've been through so much with Tom, and he has closed every single transaction with me. I don't think we ever dropped a ball, right?
I can't think of one.
Actually, I do remember one, and I will love to bring it up later today. So please stay tuned with us. And so we have Tom Amberson. You're the broker and direct lender for Amberson Group.
Abramson Mortgage.
Okay.
Yes. So
Amberson Mortgage, and we'll have our contact information below. And today the goal is to talk about if we do have a buyer who's ready, willing, and burning desire to purchase, what can we do for these people? You know, what the rate is here, what we're predicting the rate to go towards, what are the options with buying down points, what are the options with soft refi, and does it cost money if you do refi? Actually, you know, I want to bring this up. As funny as it is, that I was talking to a girl who does my nails, and she goes, how did she say? And I was like surprised, and she's like, the agent told me that don't buy a property yet, wait until, or oh my gosh, what did she say? I think she said, okay, this is what she said. She said, the lender said, go ahead and buy the house now, and then when the prices come down, you'll adjust the purchase price. I'm like, no, you can never adjust the purchase price. He probably meant that you can adjust your interest rate.
Your payment, yeah. If interest rates come down in the future, you can refinance to a lower interest rate that would lower your payment. Your purchase price is never going to change. Once you close, that's what the purchase price is. Even if it goes up, you know.
I know, but we being in business, we feel like it's a given. But people out there really need to know all these tiny details. So we will be addressing those today. And what I want to start with, but not necessarily stay on it a lot, because today's purpose of the video is to find other solutions. But what's the reality today? What is the rate today? And what the required credit score, whatnot, and then we'll go into finding different ways how we can help our buyers to buy if you're ready and willing.
Okay, so there's a lot of misconceptions in the one standard interest rate. So when people ask what the interest rate is, usually what they're referring to is just a standard 30-year fixed rate. Mm-hmm. Even on a standard 30-year fixed rate, whether it's through Fannie Mae or Freddie Mac, your final interest rate is a function of how much money you put down. Mm-hmm. So one of the things that lenders calculate is what they call an LTV, which is the loan to the value. Mm-hmm. The more money that you put down, the lower that the interest rate is going to be. One of the other functions is your credit.
So more money you put down, the lower the interest rate.
Correct. Correct. So if you're putting down 20, 25, 30%, you're going to have a lower interest rate than if you're putting 5% or 10% down.
Cool.
Okay.
So basically, you, as a buyer, as long as you're showing up for the lender with less risk, then they're giving you a lower rate.
Yeah.
Okay.
So
nice.
Loans are all based off of risk. So if you put more money down, and then is whether your credit. So the higher your credit score, the lower your interest rate. Mm-hmm. Conversely, the lower your credit score, the worse your credit score. The minimum credit score typically is about 640. There are some investors and some other types of loans when you're talking about non-traditional credit that will go lower than that. Okay. So it's a function of your credit score, how much you're putting down, and then also it depends on what type of property it is. So for example, if you're buying a single family residence, you're going to get better pricing than if you put 10% down on a condominium. Okay, there's more risk to a lender because if you default, they have to pay the association fees and all kinds of things. It's harder to go through the foreclosure process for them. So that's another risk level. So there's so many different variables that go into the final rate. So that's why when everybody says, can you give me a quote on the interest rate? Lenders are just giving you an approximation, and it can change from there.
Well, that's good to know, right, guys? And that's why, like I said at the beginning, if you are considering purchasing a home, Tom, he is a very, very busy man. But if you call me and text me, I'll make sure to connect. And we very often meet at my office, face to face, sit down, talk about everything. And then we really, really hold your hand to see which one is the better option. Because let's say you're thinking that you would like to buy a condominium or a townhouse, and the homeowners association, there could be sometimes 2-3 homeowner associations, and you're not aware of them, that they add up. So let's say you're planning to buy a townhouse for $425,000, but if your homeowner association is combined comes around $300 or more, then you're better off to buy a single family home for $500,000, because theoretically every month that's almost going to be the same expense that you will have, because amortization of home loan, it goes very differently over 30 years.
Correct. Yes, one of the main functions that lenders look at is what they call your DTI, which is your debt to your income. Your monthly debts divided by your monthly income. So if one property has $300, $400, $500 in homeowners association fee and another property doesn't, even if that property is worth more, your total payments are going to be less, which means your debt to income ratio is less. So theoretically, sometimes you can afford a more expensive property if it doesn't have the high HOA. Also here in Nevada, taxes are different for different homes.
Oh, okay.
It's not based off of the purchase price like other areas in the country. So sometimes a higher priced property in one area of town has lower taxes than another property. Newer properties tend to have higher tax rates than older properties.
So cool.
So
I just learned this.
So there's so many different variables that go into it. So that's why a knowledgeable loan officer is going to check all that information
like
first,
Tom,
so that you don't have problems at the end.
Yeah.
So I tend to do a lot more work up front with the client so that they have less problems and the escrow goes through smoothly. So.
I appreciate Tom so much, and there's one thing that always scared me in lending, and I didn't want to be that agent to begin with, because it's always the agent's fault no matter what. And in the beginning of my career, and sometimes in between, when my clients came on board with their choice of lending, one thing that always made me literally like angry, it's like lenders tend to bet and switch. They will tell you one thing in the beginning if they're not drilling so deeply into all these little details, and they give you like some sort of a base code. And then at the signing table, and this literally did happen to me, and my buyers really walked away because what they were told and what they saw at last minute totally different, and the lender wasn't even answering the phone to explain what happened. And they just go off of the fact that, okay, people emotionally connected, they already spend money, they're literally packed, and where are they going to go? So it is important, please, like whenever you're working with a lender, work with someone. And I have to tell you how much I appreciate you, because whenever you quote my clients where like the estimate is maybe $2-3, and you estimate always higher, not $200, not $2, I mean like couple hundred, but you always estimate higher. And I will always come to the closing table and the clients are happily surprised, including myself. I mean, how many mortgages did for myself?
Many over the years, but it's much easier because there's so many fees that go into it between escrow, title, appraisal, credit, lender. There's a litany of fees that we don't know. It depends what services they pick. So I will tend to overestimate at the beginning and say, okay, you're going to need to bring in $15,000, $20,000, and I'd rather it be lower at the end and estimate low and it be more. You've heard the nightmares. I've heard the nightmares. I get phone calls. I know we didn't go through you. We went through XYZ lender. They told us we were going to need to bring this. We're closing in 2 days and now they want an extra $5,000 that we don't have. Can you help us? Well, 2 days prior to escrow, there's nothing that I can do. But that's why that's why I have chosen to do things the way that I do to make it much easier on the client. Okay.
Absolutely. And as a team, it just works great because I'm pretty sure that I do my part too. And just like overall, when you work with a client, and even if I represent a buyer, I still feel also obligation against the seller because this person is also removing his property off the market and life goes on. They have their own plans. They're probably packing and relocating. Maybe they're buying another house or leasing. So when the agent from this side or the lender or anybody is not doing their part, it just, at the end of the day, everyone gets hurt. So choosing the right people to work with and taking this extremely seriously. And I really go for and appreciate full-time lenders, full-time agents, people who are in the industry, continuing their education and really understanding what they have to do. What do we got? Trash today? Well, it's real. We're not on another planet. So yes, it's trash day today. So please be patient with us for maybe 2 more minutes. Looks like they're almost done. So another question I have for you, if we can introduce a little bit of innovative ways, people hear, but maybe they don't know exactly how it works when it comes to buy down a point.
Okay.
And the second thing is doing a refi.
Okay.
I would love to hear your opinion if you think that rates might come down anytime soon.
I would anticipate rates to be a little bit lower towards the third or fourth quarter of this year. Most people are anticipating it happening sooner. Just nobody has a crystal ball and knows what's going to happen in the future. But with the Federal Reserve raising rates high at a record pace, they've never raised them this fast, this quickly. There's going to be a ripple effect where it slows down the economy. That's going to cause the Federal Reserve to lower interest rates. One of the main things that they're fighting is inflation. We had record inflation at 40-year highs. So for most of us in business, most of us haven't been around working more than 40 years. That's all-time highs for us. Wow. So that has come down, not down to the target level that the Federal Reserve wants. They want inflation down to about 2%. So as we get closer to that, towards the end of the year, to their mandated target, you will see them reducing interest rates. When the Federal Reserve reduces interest rates, it flows through, sometimes at a slower pace, to the consumer. So my best guess is towards the end of the year, third quarter, fourth quarter, you may see interest rates lower. I don't anticipate us going back down to where we were getting 30-year fixed rates at 2.5% when they were giving away free money and they had a zero interest rate policy. But you may see a 30-year fixed rate that the first number is a 5, mid-5s.
That was awesome. I'm the first one who's going to refi because
everybody always tells me, oh, interest rates are so high. When I started 35 years ago in the business, interest rates were ranging between 12 and 14%, and people were buying houses all day long. So whatever the interest rate is, you have to make sure that that payment and your costs fit into your budget. Your house is just one expense. You have food, insurance, all the other things that you pay for. So if interest rates are at 5% or 6% or 7%, what is that payment going to be for my house? And does it fit into my budget that we can afford? And that's one of the main things I do is sit down with people to make sure that they can really afford this for their life.
Well, I understand, and there's a saying, which I agree, and it says you are marrying the house and you're dating the interest rate, meaning the interest rate can fluctuate, just like we see the last years up and down, but the purchase price. So going from the space that we have right now in Vegas, low inventory, which is a fact. We have very low inventory due to so many factors, even starting from the understanding that a lot of people bought super, super cheap homes today in Vegas and they just don't want to sell. I actually have investors who are like, well, sell and do what? They have to pay so much taxes on it, and they're already getting such a huge return with the rental. So a lot of people don't want to sell. Some people don't want to sell because they lock their rate. And we have a third option of people that don't want to sell because they love their house. So very often, not too often, and somebody wants to sell. So we have low inventory for that really real reason. And here, if the rate comes down and we don't have enough inventory, obviously the price is going to come up. So that's why this video is perhaps partially an encouragement. Again, if you're ready, willing, and really have this burning desire that you want to buy a place or your family grown and it's time to change, then take advantage of at least slightly lower prices and do a soft refi. Does refi cost money? Refinancing.
There are different options depending upon your individual situation. If you have the equity in the house and your credit is good, there are no cost refinance options.
Oh, right.
Okay, so that is an option. It's not available to everybody, but for the better consumers, it is.
Excellent.
So
well,
yeah, and we've done that several times. In fact,
we're doing it to me.
From 2009 through 2020, we were in an era that interest rates just kept coming down. Yeah. So people that had bought 6 months later, interest rates were lower, so we did a no-cost refinance to get their payments down. Excellent. So if interest rates go down, you always have that option.
Nice. So the question, thank you so much. So many things are going fast, and let's go back a little bit and talk about buying down a point.
Okay.
If you could explain.
Okay, so there are two different types of buy downs. There is a temporary buy down and there is a permanent buy down. Okay. Right now, when most people talk about a buy down, they're talking about a temporary buy down. So the way that works is there's several different ones, but some of the more popular ones are what's called a 1-0 buy down, which means for the first year, it's a 30-year fixed rate, but for the first year, you're 1% below the base interest rate.
Okay.
So if your base interest rate is 6.5%, the first year you're at 5.5%, year 2 through 30, you would then be at 6.5%. Okay. Another popular one is a 2-1 buy down. So if your base rate is 6.5%, the first year you're 2% below, so you'd be at 4.5%. The second year you're at 5.5%, and then year 3 through 30, you're back up to the 6.5%. Each one, there's a certain cost to the buy down. Okay. And it's a mathematical calculation based on how much you're saving the first 2 years. So originally those buy downs were designed for a certain type of client. Somebody that was more maximizing their price, but may have been younger or middle-aged where their income was growing, where they wanted the lower payment the first year. They didn't care if it went up 1%. If their payment goes up $200, depending upon the loan amount, their income went up more than that in the year because they got raises at work and they could handle it. So that's initially years ago, 30 years ago, who the buy downs were meant for. The other type of buy down is a permanent buy down, where if you have a 30-year fixed rate at 6.5%, you can buy it down to 6.25% or 6% for the life of the loan. And there's a certain cost associated with that, where it's permanently for that whole 30 years. There are certain points associated with paying that down. So a lot of times that was designed where if you have a seller paying closing costs, depending upon the type of market. Sometimes in a buyer's market, sellers pay closing costs. Sometimes you have companies that are relocating a buyer. I've had clients relocating from the East Coast to out here, and their company is 3% of their closing costs as an incentive to relocate them for their job. Well, we use that money to permanently buy down their loan.
Well, right now I just accepted literally 2 offers back to back, and both my sellers were willing to pay closing costs, and one of them was very interesting because the buyer is putting down $80,000, but yet they're asking for $3,000, and my seller was like, what is this? You know, I mean, obviously he has money. Why does he need this $3,000? And my answer was because this is for a buying down, probably on a half a point or whatever their lender had in mind. And sometimes, and Tom will probably answer this better, the buy down has to come from the seller. So this also an information for people who are selling to be open. And if you're working with the right agent, they can build it into a purchase price. So at the end of the day, for you as a seller, you don't really get money out of the pocket. So let's say the purchase price is $100,000 and they're for $5,000 by closing costs. So we will structure that the purchase price is $105,000 and the seller is giving $5,000. So at the end of the day, everybody wins as long as appraisal comes at $105,000, which is, you know, and so this is why when you're working with an agent, we do comparison market analysis to make sure that the appraisal does come in or the property has a lot of improvements. And usually I have a big list that I provide to an appraisal and help value to come in if my clients have improved their homes. And lately I see a lot of people have improved their homes a lot.
Oh yeah.
So that's
yes.
really great.
And values still are holding steady and going up. The market is not collapsing with prices. So you have that ability to do a little bit of a creative thing to help the buyers.
Sure.
So we're seeing that quite often.
Quite often.
Yeah.
Well, when we started, you know, I talked about one trend go through for us.
Yes, I'd love to hear. I don't remember.
Yeah, this was a beautiful family, and the husband made a mistake in terms of he had a child that he did pay his child support because he is an incredible individual, but he was giving cash to the mother monthly. And when time came for them to buy a house, in the middle of escrow, she heard that they're buying a home, and then she went to court and said that he never paid. So then there was a huge lien against him for non-paying child support. Okay. And that's what became...
So it was a cloud on the title, so we couldn't do the transaction.
Yeah.
Okay.
Yeah.
So that's why I didn't remember not being able to get their loan approved. That is a separate issue than the loan.
Yeah, it wasn't on you, it was, but as a transaction, it was like, okay.
I don't remember it, but...
Do you remember your own, like something got unglued, like I know, I'm not saying it's your fault, but what did the buyer can do wrong? What suggestions? I heard people financing a car in the middle of transaction. Well, that's a big no-no.
In 35 years, I've had all kinds of things happen in the middle of transactions. So any seasoned real estate agent that's been around a long time and done a number of transactions, they know not every escrow goes through smoothly. Okay, and it could be something that the borrower with the house. There's all kinds of reasons. One of the first transactions I ever did, and this was a great learning lesson for me. There were 2 different instances that came up during the middle of escrow. So the first thing that came up was I had pre-qualified the buyers, and when you pre-qualify somebody, you get their income, their credit, all kinds of things. So they had told me what their income was, and they had told me that they had 2 car payments, blah, blah, blah. So I calculated out their debt ratio and said, okay, here's what you can afford. This is the maximum that you can go and buy. They went out and found a house that they fell in love with. Their agent did a great job. This was 1990. This is how long ago it was. In the middle of escrow, when an additional background check was done, it came up that they had a 3rd car loan that they never told me about. So I happened to call their agent because my philosophy is there's things that are going to come up wrong. If you let everybody know, work together and see how to fix it. As opposed to a lot of lenders that don't tell anything, and then at the end, well, we have this problem, this is why we're not closing. So I talked to the agent, and the agent said, when I was driving them around, they mentioned that they had just co-signed on a car loan for their sister. So I called them up and I said, I'm having problems with your debt ratio because this third car loan, your agent told me that you just co-signed on this loan for your sister. Is she the one that is making the payments? And they said yes. So I was able to document that it was the sister's loan. The sister made the payment. I got it removed so that their debt ratio is now in line, showing that it really wasn't their debt, so that their debt ratio was fine.
But don't you need 12 months?
12 months,
okay,
yeah.
Good. So,
yeah.
So if you just co-signed...
it had been, the sister had been paying for about a year and a half. So luckily we could get 12 months payments. So then as we went further, this was back in the day when lenders ordered their own appraisals, not going through an appraisal management company.
Oh, so much has changed.
Yeah. So I ordered the appraisal. The appraiser went out there and appraised the property and appraised it low below the purchase price.
Same people.
Same transaction.
Oh, poor thing.
So I called the listing agent, which lenders never do, but my thought was, the listing agent priced this, maybe they have some comps that the appraiser didn't know. So I called the listing agent, and she was so happy that I called her, first of all, because she never had a lender call her. And I said, I'm having problems with the appraisal. The appraisal came in low. Do you have some other comps? How did you price the house? And she says, well, to let you know the truth, the appraiser you sent out is the ex-husband of my broker.
Oh.
So I said, well, I apologize for that. I called the appraiser and said, how come you did not disclose this conflict of interest? And he says to me, well, if I would have told you, you wouldn't have hired me and I wouldn't have gotten paid. I said, you're absolutely right. I wouldn't have hired you because it's a conflict.
Sure.
So I went out and I paid for another appraisal. Another appraiser went out there, appraised it fine. The house was fine. And we were able to close the transaction. But the point is, lenders have to have communication with all the parties involved, the agents. You never know when it's going to be an issue with the property or the homeowners association or credit or something like that. And you as agents, when you're driving around the clients, you get all kinds of information that they tell you that they may or may not tell me. So that's why it's always good for me as an agent to communicate with you. And that was a lesson that I learned within my first 6 months in the business 35 years ago. So
nice. That's a good lesson to learn.
Yeah.
And, I can't stress enough talking about the fact how emotional it is of purchasing and selling a house and how much everybody's energy and intention plays a role, and picking people to work with who are very clear-minded and they are focused on the end result and the best result. They're not looking what they get out of it. They're just doing it for your highest good. It's extremely important. And speaking of this, like that I mentioned, I have 2 transactions right now going. One of them, I couldn't get hold of the agent. No matter what I did, every time I texted her, she's like, or called her, she would text me like, oh, I'm in a class. Oh, I'm this, I'm that. And I'm honestly thinking she probably just at work. And guess what? Because of the way she was operating, she dropped the ball 100% for her client. And we end up accepting another offer. And it's on her. Like, it was totally on her that she wasn't communicating with me. She because some stuff I don't want to document it. We need to have a conversation. We need to understand the intention and work it through, and it was 30 minutes that broke everything because their calendar expired and I got another offer, and I went with not me, but my client obviously went with the other offer just because her lack of communication really screwed up things for her buyers. So it matters. It really matters all day, every day. And it's not only at the beginning, it's the whole entire process of when you go through, even when the inspection reports come back, how many little details. Yes, it could get expensive for the seller to fix something, and the choice of what you're going to go with the handyman, you're going to go with the contractor license, the timeline, everything matters so much. And I'm very, very proud to say I have an incredible team throughout so many years, of great team of handyman, contractors, electricians, you name it. And thank you guys also to them, if any of them are listening, because I so appreciate them prioritizing my transactions. And like just literally right now, my contractor, he's like dealing with 4 or 5 homes that last minute we had to make some repairs.
Yeah.
And it's really good to have someone who would go on Sunday and fix a water heater. So when I'll put a stripe on a water heater, so if we have appraisal Monday, that's not going to be a contingency, which is you think it's a small thing, but trust me, it could be kind of like a big deal when it comes to closing, because real estate is like a ticking bomb sometimes, I say, and why it is, it's because let's say Tom locked the rate and he was able to get a great rate, great condition, and then I'm not able to close on the 5th of February, February 6th, now there's a lot of things that needs to be redone, including the rate is no longer locked. So, and if we don't do the repairs on time, all of this is pushing things back. So whenever you're in a transaction, you need to know your agent and your lender every day are doing something. And sometimes 30 days might not even be enough, just if there's holidays or appraisal runs late. Now we see better, like my appraisal came back within 2 days. Nobody's busy anymore.
Well, the market changes. So it all depends. The appraisers are busy when the market gets busy. So right now, the amount of transactions are not nearly what they were years ago. So appraisals are coming back much quicker. But that can change next week, next month. You just never know. Same thing when the loan goes through its process with underwriting. We're getting answers back much quicker. So everything is going through quicker now. You said Esther's like a ticking bomb. I've always said it's like a big puzzle, and you have to put all the pieces together. The difference is nowadays in 2024, the amount of pieces in the puzzle, there might be 1,000 pieces that we as a lender have to deal with, where 15, 20 years ago, it may have been 30 pieces. Wow. It's gotten much more complex. So the lenders go and be educated on the guidelines and have the experience to go through what comes up during an escrow.
Yeah.
So
my final question is, please God, I just remembered, but I wanted to wrap it up and saying stuff like, for example, if somebody is ready and willing to buy and they're relocating, this is what they're coming from another state, and they have, what's the structure? Because this one I'm personally confused too. If they just got hired to a new job here in Vegas and it's similar to the field they are, can they qualify immediately, or they still have to work in a new place for 2 years before they can qualify when it comes to relocation?
It all depends on what the job is. Okay, if they are taking on a new job and they are on salary, where we can verify this is what their salary is, or if they have a guaranteed bonus, we can use it. But if they went from a job before that they were on salary and now the new job is 100% commissions, we don't have a history of how much their commissions are going to average, because commissions change month to month. So that type of borrower typically needs a long enough period where the underwriter feels comfortable with what their income is going to be to show their ability to repay the loan. Typically, the actual guideline says 2 years, a minimum of 1 year under certain circumstances. So I've actually done it where it's been less than 2 years. if I could show that they had a guaranteed minimum commission of a certain amount, we could use that amount. So it was somebody that was on salary plus commissions, and I was able to generate enough verifiable income for them to qualify with their debt ratio.
Yeah.
So the answer is,
Okay.
it's a big puzzle. Everybody's situation is different. There's no one clear-cut answer. Somebody is going on salary. I had somebody that we just closed last year that was moving from Canada into a completely different job. But they had a contract with the new company, and it had their start date and what their salary was. And we were able to verify all the information. So the underwriter was able to use that salary for qualifying purposes, and they were able to buy the house.
Excellent.
So I've had people be on the job one day under certain circumstances. So,
Well, I really hope you guys find this useful, and we're both very busy people, but we're doing this in order to help you with your future. Owning a home is an amazing feeling. Being an investor, it still is maybe not as good as it used to be, but it is a way to become rich. And if you are thinking about investing into real estate, investing into Las Vegas, Cole, we work with investors all the time. And also, if you're buying a home, please think of us. Inessa and Tom here from Las Vegas. Thank you, Tom, so much.
You're
I
welcome.
appreciate your time. And there's so many questions, more questions that I think as you're talking, like Canadian buyers, like international financing. So maybe we'll do another video sometime soon.
would love to.
Okay, excellent. All right, guys. Bye.